It's really recognizing that different asset classes will move differently, and different asset classes, some of it would have a positive correlation, that means they move in the same direction, while others would have a negative or inverse relation, that means one goes up, the other investment class goes down, and vice versa as well. All right. So what I actually want to draw you to is the one that's actually labeled AA. All right. So AA is actually short for asset allocation, and you'll see that while the others swing up and down on the extremes, you see that the asset allocation actually hovers within the middle band in terms of the overall performance. And that's because, when you actually do proper asset allocation, it actually helps to reduce volatility of your investments. So really the whole idea of asset allocation is actually twofold. One is that you want to minimize volatility as well as maximize returns. So the whole idea is that even if you have two different asset classes that are, let's say, high risk, for example, but because they have a different correlation when it comes to investment returns. So by actually having multiple different investment asset classes, not too many, within a certain reasonable range, it would actually help to increase returns while reducing the volatility or the risk of your entire portfolio itself. And that's really the beauty of it. When you can put different high risk investments together, and at the same time, it doesn't increase the risk of your portfolio, but actually increases your returns as well. So generally, for most investors, definitely you want to get exposure into all five of those asset classes because it just offers that level of diversification, as mentioned earlier. Cash, equities, fixed income, properties, alternative investments. It helps reduce volatility by 90%. It accounts for about 40% of your returns. So the minimum you're actually looking at five different investments. Yeah, but it doesn't make sense, if you for each of those you have so many investments that you're unable to actually manage as well. And actually also looking at what um most investors will consider as a single investment. Let's say you use a unit trust or robo-advisory, etc. Technically, when you actually put it in there, you are actually already splitting it into various different, uh, individual investments itself. Yeah. So you would want to have that level of diversification within each of the asset classes, but it doesn't make sense to be holding, 30, 40, 50 different investments because there's way too many for you to even manage and to monitor as well. And even if they're again, say one or two of them will do really well, but it actually has very little impact on your overall portfolio returns just because the amount of investment is too small that was actually placed into each investment. So in short, basically invest in all the asset classes, and then within each asset class, it should actually be diversified. So for the average investor, I would say individually, that means going into that specific level investments, probably like 10 different investments at that level, which would already be sufficient. Even before you actually look at, what stock to buy, this stock still can buy, will it go up, or any particular asset class. More importantly, as an investor, you actually need to look at it from an overall asset allocation perspective. Yeah, this means taking a step back really, because I know for a lot of us, we invest based on our experience or what someone recommends to us, or maybe what you read online, and we have a little bit of investments here and there. It's all like rojak together, when ideally what you should have is you should have that perfect investment plan, how your asset allocation should be, how you should be diversified. Then only look at all the pieces to actually fit into your investment portfolio.